It's not direct financial advice for your particular circumstances, but we do love getting your questions in. So thank you for all of those. Scott, my guest host, is standing by. Let's bring in our next guest, though, Marcus Bogdan from Blackmore Capital. Now, Marcus, this is no reflection on your age. This is a question about experience. Do you know how many reporting seasons you've been across professionally?
Well, full year reporting seasons, this is my 30th coming up. So I can say that I'm a veteran and still learning.
All right. Well, can we learn from you then, Marcus, please? When earnings season rolls around and these reports are dropped to the ASX, you've got to do your work. I mean, there's some questions coming in, and I think that one thing that's come through so far is that it's not necessarily easy to just look at that headline number and go from there, particularly when you're investing your money. So where is your focus when it comes to earnings?
Well, it is a lot of the preparation you do before earnings season starts and the knowledge you have of those companies and the history of execution is incredibly important. So having that basis of knowledge allows you to look at those results reasonably quickly to understand whether they are performing within expectations or not. And certainly the earnings is important, the conversion of cash, and looking at those returns through the investment cycle is also a really important consideration that we look at. And like your former guest, we are focused on the medium to long term in terms of being able to give those sustainable returns through the investment cycle.
All right, so if we break it down, where is your focus in terms of, say, margins? I mean, what is the view, what is the foundation that you look for then in terms of margins?
Mm-hmm. Well, we certainly want to see companies growing both their revenue, but also being able to see that translated into earnings. And that is that sort of underlines the quality of the company. So that translation to earnings growth is incredibly important. So we do look at the margins of the business, particularly through the cycle. And what we're really trying to answer is, where is this company in its investment cycle? Are returns about right for this sort of company and for this industry, or are they over-earning and there's risks there that returns are just too high? Or have we got the opportunity that returns are actually lower than historical averages and the company has got a very clear footprint and catalyst to close that gap in terms of their margins?
Scott, would you agree?
Yeah, I think that's right. I'm actually curious, Marcus, from your perspective, without wanting to go back to those 30 earnings seasons necessarily, or 30 full year earnings seasons, what you feel like has been different and the same? How have investors' expectations, companies' results changed? Are there things you're paying more attention to, either because of your own experience or because of the way the market or the organizations have changed?
Yeah, no, I think that's a really important point. I mean, there are historically really strong things that we will always look at, and that is earnings quality and balance sheet strength. But also in the short term, and to your point, understanding what the market expectations are for those companies, what consensus earnings are, and how they're tracking towards those is also particularly important. And that's where you get that sort of short-term, potentially that short-term volatility that you see around earnings announcements. So being aware of that beforehand is incredibly important, but also have an underpinning yourself in terms of what you think that company is, because then that can give you the ability to buy where you think you can close that intrinsic value.
Well, could I ask a question on behalf of one of our viewers? Peter has written in and said, what is the difference between return on capital and return on equity? Marcus?
Well, the capital is particularly important because that's the capital that companies are putting actually to work terms of the capital expenditure, the acquisitions that they're making, and measuring the execution around on capital and the return on capital, and making sure that that is above the cost of capital is a really important metric. And so that is the measure that we would look at, particularly for industrial companies. When we're looking at financial companies, well, then we do turn to more balance sheet and shareholder returns and looking at return on equity. And for example, for many years, the Australian banks had a return on equity in the mid-teens, and at that stage they were over earning. That return on equity has now become more compressed, and it's now around 10%, which is around the global average. So it's depending whether you're looking at sort of industrial or mining companies where the return on capital is particularly important, or whether you're looking at financial services companies.
You mentioned dividends there, Marcus. Dividend payout ratio is important. Again, is that very sector specific as to what you are actually looking for? What would be, a bad dividend payout ratio in a particular sector that would turn you off come reporting season?
Any dividend payout ratio which is unsustainable, and the greatest example that we've had in sort of recent Australian corporate history has been the Australian banks. And for many during this decade, those payout ratios were just too high. And companies like NAB, and they just held on, but it was inevitable because the market was saying those dividend yields of 7 or 8% are just not sustainable. And what we've seen now is much greater discipline by the banks and bringing those payout ratios down to around 70% rather than 90 to 95%. Telstra is also a great point in case where those dividends were unsustainable. At one stage, Telstra was paying dividends of around 32 cents. That's now been based back to 16 cents because it reflects the underlying earnings of that company. So payout ratios is a really useful metric, and the closer they get to 100%, the greater the sort of the detail you need to look at to see whether that's sustainable or not.
Marcus, Scott here. I wonder from your perspective whether, if you look at you're talking about maintenance and growth capex. On the other hand, we're talking about the dividend payout ratio and how much is too much or not enough. That kind of triangulates pretty nicely. For some investors, unless you really dig super deep into the financials, this can be a little bit hard to do. But given the example you gave of, say, Telstra, for example, I wonder if you can triangulate those things for us. Obviously, easy in hindsight to say Telstra was an example. Maybe there's some of now that either are really good or really bad dividend payout ratios you're not comfortable with. But just kind of triangulate that for us in terms of how you consider the other uses for cash, the requirements for cash, and then the dividend in the other context.
Yeah, absolutely. Because as Australians, we are obsessed with dividends. In fact, we're the third highest paying dividend yield country in the world, and so we do have a focus on dividends. But then it comes back to how sustainable they are. And to your point, companies have to reinvest back into their businesses. There is maintenance capex or stay in business capex, which is particularly important just to keep that business operationally. But we also want to see companies that are really disciplined and focused on allocating capital for growth. And so the growth is important because hopefully that will lead to higher earnings and then ultimately higher dividends. So all of those mesh together, as you have alluded to, and they are incredibly important. And each one of those we spend a lot of time thinking about.
Marcus, so those are metrics that you think about all the time, every reporting season over the past 30 years. This reporting season, though, when you zero in on these reports, when you hit Control F, What are the big thematics? What are the themes that you're going to be looking for first?
Well, the first theme that we're looking at has been the attention that we're seeing around costs and inflation, whether it be inflation in terms of labour and labour availability and or raw material costs. And what we do want to see in the companies that we're investing in is the really good companies in the industry leaders being able to absorb those costs and being able to pass those costs through and still generate not only good revenue growth but also earnings growth. So that will be front and centre. Good industrial companies like Amcor and Brambles is one case in point. How companies are thinking about capital allocation. How much are they putting into growth capex? How confident are they about investing into the future? Their thoughts around dividends, excess capital and buybacks. Those are also really salient things that we're thinking about. And then in the shorter term, obviously thinking about the impact of the lockdowns that we're seeing throughout Australia and potentially in other jurisdictions as well, and what that impact will be on short-term earnings. And then the final point is that we are looking at the guidance or the statements around outlook. What is their visibility, their clarity around the future, and which was already mentioned, those better businesses, those more resilient businesses have probably got far greater clarity rather than potentially a contracting business. So those companies like Endeavour or Woolworths or Wesfarmers, we would expect that it should be business as normal.
Marcus Bogdan, Blackmore Capital, it's always a pleasure. Thank you so much. We look forward to seeing you on the AusBiz live stream soon.
Thanks very much, Nadine. Cheers.
And thank